Welcome to a Westpac China in 2020 update. My name is Elliot Clark. I'm one of the senior economists based in Sydney for Westpac, and I'm joined today by our head of market strategy for Asia, Francis Chung, who's based in Singapore. Francis, welcome, and to all our viewers, welcome. Francis, if I might, can I start by sort of thinking about or asking you about the sentiment towards COVID in Asia currently, and also in particular about sort of the expectations around China's recovery now that we've got the Q1 GDP number?
Yeah, there is still a fair bit of cautiousness in Asia. The biggest uncertainty is apparently when this virus can be contained, which is pretty much a medical issue. Only when the timeline on this medical front becomes clear can investors make their own calculations. Economic data have been sending mixed signals as to how economic activities are performing, and various indicators put the work resumption rate in China in the range of 70 to 90%. While we need to be cautious in the interpretation, at this uncertain time, I think it is fair to say that mixed signals should be considered as positive already. Elliot, what is Westpac's central view for China this year and in 2021?
It's obviously been a very volatile time, but now we do have the Q1 GDP data in and some of the partial data for the month of March as well. We have revised our figures and are feeling more confident in the recovery that's coming. So just to recap, what we saw in Q1 was a annual growth outcome of minus 6.8. That came from a plus 6% outcome as of December. So a very large swing in terms of the annual growth rate. But what we have started to see in terms of some of those detail for the March preliminary data is a situation where we've got the beginnings, I suppose, of a recovery. So that's what I'll highlight there, I suppose, in some of the partial data, particularly around credit and investment, which we'll talk a bit more about in detail in a second. That's really starting to show that we have seen a base form and there is reason for optimism. But as you kind of highlighted earlier around sentiment, really what's allowing for this to happen is that China has seemingly got the virus under control. We're seeing very little sort of new cases come to be announced, and that seems to be sort of seen as being sort of consistent with what's actually happening on the ground. So that's definitely the basis for a recovery starting.
So, Elliot, what sectoral developments are necessary for this outlook to be realized?
I think what's really important at the moment is we get manufacturing and sort of broader industry base back to work. And what we need to see there is obviously sort of a balance in terms of activity, but also then the confidence return. So the manufacturing PMI that we saw a few weeks ago now, that did point towards momentum not only coming back and getting kind of stabilisation in activity, but actually positive outcomes in terms of growth in the sector. So the outcomes are around about 52 for the PMI, which is above the 50 expansion contraction measure. What I also mentioned before around investment, we have started to see some more positives there. They are more tentative. We haven't really sort of seen more than sort of a stabilisation in terms of the growth rates at very weak levels. But if we look to the credit data, that does suggest that we are going to see a turn as we sort of go forward now and see a strong sort of bounce that will come through in the next couple of months, being sort of the Q2 numbers and then also in Q3. And that is really where we do see a very strong outcome coming through, which will then see growth come from that sort of minus 6.8 back to a flat outcome for 2020, and then sort of something more like a 10% growth rate for 2021. So Francis, with that sort of background for the growth view, can you detail to us how Chinese monetary authorities are looking to try and support this activity rebound?
Now, China has been mostly focusing on targeted measures when it comes to monetary policy. The priority is on providing liquidity and enhancing credits. The PBOC has delivered both headline and targeted reserve ratio cuts. The lowest applicable reserve ratio now for smaller banks will be 6% when all these cuts take full effect. Additional special and relending facilities have also been granted at preferential interest rates with MOF subsidies as well. There have also been some interest rate cuts, including those on open market operation instrument and on the benchmark loan prime rate. PBOC's current aim is to enable affordable credit to the sectors in need and to prevent any liquidity problem from developing into a solvency problem. There are already initial signs that these measures are working, as reflected by the aggregate financing and loan data.
And can we sort of think about now, what are the implications for the RMB of the current situation and also that monetary policy stance?
Now, while the PBOC is likely to stay on an easing bias, it is unlikely that the PBOC would be as aggressive as the US Federal Reserve in terms of interest rate cuts. And indeed, across the board, interest rate cuts might not be deemed as the most effective policy reaction in China. So in terms of the interest rates policies, yield differential should stay favorable for bond inflows into China. And bond inflows is one of the two key factors that we consider as supporting the renminbi. We reckon that index-induced bond inflows this year can be potentially up to $110 billion. And the increasingly supportive monetary environment should not stop these flows. There may also be some portfolio diversification needs. Another support factor is China's imports. Imports may be less of a leakage this year. China's imports of services, which include the like of tourism and education, will likely reduce. This will add to the current account balance. China posed a huge trade in services deficit, and that undo more than half of the goods surplus last year. So again, take last year's data as a reference. A 10% reduction in its import of services would already be able to boost the current account surplus by more than 1/4. Less domestic demand for dollars for tourism and education spending is a supportive factor for the renminbi, and that is kind of a buffer against the downside risk to growth and exports. So on balance, we expect the renminbi to be trading in a range against the dollar. Elliot, can you outline the key risks China faces over the coming years?
Yeah, there are certainly a number of them. Obviously, the first front of mind is really the virus. So if we were to see a second wave come through China, as is now threatening Singapore and a number of other Asian nations, then that would be obviously a significant shock to growth, and would see growth potentially through the whole year this year being negative, a more modest rebound next year. In addition to that, we mentioned before kind of the importance of investment. It's not only important that we start to see the private sector start to invest, but we need to see all state-owned enterprises come through and provide more support there, so a broad base for investment. And equally, there may still be a need for the government to come in and provide more sort of targeted active sort of stimulus in the economy as well. So that's, I guess, a buffer against risks, but does emphasise that there is a need for the careful watching from the central authorities and making sure that the progress is being made as they anticipate. The other thing just to note is that we are in a situation where the consumer was an increasingly important part of the Chinese economy. And we need to see them come back to work with industry. So it's important that industry doesn't actually try and minimise their wage bill or the overall sort of hiring that is happening in the economy. That sort of structural trend towards higher income jobs needs to continue. And for that to then come through, that will then provide the impetus to consumption over the longer term. So not just the next year or two, but even the next 5, and provide that sort of structural sort of strength in terms of Chinese growth. The other point I might just note there as well is that we have to be mindful of the global picture. So we are expecting a sort of minus 3% growth outcome from the world at large as a result of very deep recessions in the US and also in Europe and more broadly across the developed world. And if that there is the capacity there, whether it be because of the immediate weakness or a further sort of a sharp decline because of the second wave there is a risk that will come through and hit China's exports. And so not only will you sort of have a reduction in sort of imports, but also in exports. And that would then obviously lead to a less support coming from net exports for growth and a lower growth outcome as well.
Yeah, that's very fair, Elliot. And thanks for joining us today. Keep an eye out for further updates in coming months.